Thank you for joining us today for our webinar, Capital Markets and M&A Outlook. I am Leanne Foster, Senior Associate of Kolb M&A Advisors. We are broadcasting live from the 59th floor of Bernstein's Chicago office. My colleague John Keelick and I have partnered with Bernstein Global Wealth Management.
Someone has joined the conference.
To bring you both current information and insight into 2012. Our webinar today will provide
Someone has joined the conference.
Of historical performance, touch on different markets, and share current
Someone has joined the conference.
Bernstein offers a complete range of investment services which are designed to preserve and grow wealth. Their firm's deep research strength and global operations enable them to customize a portfolio to suit any type of investment goals,
Someone has joined the conference.
tax situation, or tolerance for risk. Kolb M&A Advisors is a dedicated team with significant transaction experience and expertise. Our specialties include M&A, strategic planning,
Someone has joined the conference.
and post-merger integration. Joining us today from Bernstein, we have Greg Young, who is responsible for strategic oversight and management.
Someone has joined the conference.
For high net worth private clients, is a member of Bernstein Global Wealth Management's Private Client Investment Policy Group and has expertise on real estate investment trusts. Jay Leonard, who works with clients and professional advisors to develop wealth management strategies for families, private foundations, not-for-profit organizations, and companies. We also have Bill Evans, who provides asset allocation and wealth planning advice to individuals, families,
Someone has joined the conference.
and foundations with a special focus on closely held businesses. Insight into the M&A outlook will be provided by John Keelick of Kolb M&A Advisors. John provides buy-side and sell-side services to privately held middle-market companies and their owners. He specializes in M&A, strategic planning, operational review, and post-merger integration. There is more information about Kolb M&A Advisors in the appendix.
Someone has joined the conference.
All conference participants are in a listen-only mode. You can submit questions to us by typing them in the chat box on your screen. We will be leaving time at the end of the presentation for Q&A. We will be distributing the slides and a recording of the seminar via email after the webinar concludes. Now, to introduce our first speaker, I will turn it over to Jay Leonard.
Thanks, Leanne. I appreciate your time today, everyone, and thanks for joining us both on the conference call as well as the webinar. Our apologies for the slight technical difficulties in the background. I think we've got that taken care of now. But so we're very pleased and excited to have Greg Young with us today. Greg is a senior portfolio manager in Bernstein's Private Client Group. Greg's role directly ties into our investment process and portfolio decisions, so I can't think of anyone better to help us provide a recap of what happened in 2011 from a capital markets perspective and address the opportunities that we see in the markets going forward. For those of you joining us today who may not be familiar with Bernstein as a firm, allow me just to take a minute and a half to give you a brief background. Bernstein as a firm, we were established in 1967 with really
Someone has joined the conference.
Provide world-class institutional-like investment research and money management for our clients. Our clients range anywhere from private clients to foundations and endowments to some of the largest institutions in the world. And research really informs everything we do here. We've amassed one of the largest global investment research groups in the industry. We have 257 research analysts across the globe helping our clients achieve an information advantage that has led to successful outcomes over time. We have a specific group that's dedicated to publishing on topics that are specific to our private clients. And when I think about our research, we really break it into three specific buckets. One being asset allocation. As you can see on the webinar, we've written on everything from alternative assets.
Someone has joined the conference.
That very complex asset class and how to effectively use those within a portfolio construction, to our view on tactical asset allocation, which is what we use within our dynamic asset allocation strategy, to making sense of the current inflation environment, or lack thereof. When it comes to planning research, we've written and published on everything from executive compensation matters, from option compensation and restricted stock, to those on the line that might work with those that are in the process of selling a business, to aligning a spending policy with an asset allocation policy for endowments and public foundations. Some of you on the line that
Someone
might
has joined the conference.
or for investment banking firms or for law firms might have a cash balance plan in place. We've written on that. And then finally, and what Greg is really here to speak about today, is from an investment standpoint. And with that, Greg, I'll turn it over to you to share our view on the capital markets. Thank you.
All right. Thank you, Jay. And good afternoon, everyone. We appreciate you joining us. Happy to spend some time today talking with you about our outlook for the capital markets. And, you know, it's usually a dangerous
Someone
thing
has
for
joined the conference.
money managers to call a turn, particularly in the markets. But it's apparent in the first 6 weeks of 2012, just based on market action, that investors are feeling a little bit more confident.
Someone has joined the conference.
And probably less like.
Someone has joined the conference.
Probably feeling better than they did last year, given how challenging 2011 was.
Someone has joined the conference.
Almost all investors. And it's particularly if they're in the stock market, for stock market investors, they're probably glad to see a turning of the calendar out of 2011 into 2012, because last year was pretty difficult across the board. Were it not for the fact that we count the compounding of dividends in the S&P 500, the U.S. stock market at best would have been flat, probably would have been negative, just about like every other equity market was around the globe. There was simply no place to hide throughout 2011. And that comes on top of what has been a difficult cycle really for well over a decade. Investors in the equity market, in this case in the U.S. market, have experienced literally a roller coaster ride going back to the beginning of the prior decade. Having experienced two severe bear markets over that time, the fallout from the tech meltdown early in the 2000s to more recently the credit crisis and all of the attendant fallout from that. Having annualized over that time at really little better than flat, that's in stark contrast to what investors have come to expect over time, that's closer to a 10% return for being invested in the stock market. So it's certainly no surprise then that many investors have started to question perhaps the wisdom or the need to be invested in stocks going forward. And as if to add insult to injury, volatility has been very difficult in the market as well. When you look back last year and just total up the number of times that the market was up or down by more than 2%, it was a much larger number than is typical. Also adding difficulty to this environment, it was not an easy time for money managers, for those of us that make our living trying to pick stocks in this kind of environment. What made it difficult across the board is that equities were really not responding to their own individual company fundamentals, but really treated more as an entire risky asset class. And given the challenges of 2011, investors were sort of caught back and forth between a risk-on or risk-off mentality, and as a result, the correlations among stocks rose to all-time highs, making it very difficult for most active managers to outperform benchmarks in that kind of environment. There is good news in this story, though. After having endured a difficult period of time over the last few years, we believe that stocks have reached a level of valuation that is very attractive. At the end of 2011, on the left-hand side of this display, the S&P was at a price-to-earnings multiple of less than 12 times earnings. And that compares to, in the middle display, what is more typically at least over the last 45 years or so, closer to a 14 times multiple for stocks. But even that really understates the valuation opportunity today because interest rates today are quite low. And as you can see on the right-hand side of this display, the more typical valuation level for equities when interest rates are below 4%, and they are well below 4% today, is not 14 times, it's actually closer to 20 times. So just on valuation measures alone, we think that equities are very attractive here in the U.S. And the same could really be said, frankly, for all markets around the globe. Adding an even more compelling element to this, over and above just cheap valuations, is the fact that companies are in much better financial shape, paradoxically, a couple of years after the end of the recession and going through the credit crisis. Several ways we can measure that. When you look at corporate balance sheets today, they're very strong. The amount of debt in relationship to equity for companies in the S&P 500 are at very, very low levels. Companies have used the cash buildup and the improvement in business to strengthen balance sheets, and they still have a lot of cash left over. By some measures, almost $2 trillion of unused cash sitting on balance sheets, and you can see how that compares to recent history. We think that provides us a significant cushion for companies going forward, even though there is still uncertainty about the resolution of several critical issues, which I'll address in my brief remarks. Companies today are sitting on an enormous cash hoard that gives them financial flexibility and a certain measure of safety to deal with those circumstances as they develop over time. And from an investor standpoint, holding cash or holding stocks, well, you actually get paid better today to be invested in just in the market. When we look at where the dividend yield is, for instance, on the S&P 500 compared to sort of a benchmark safe asset like the 10-year U.S. Treasury, you can see that going back over 50 years, it's been rare that the dividend yield on stocks would actually be higher than the yield on treasuries, but such is the state of the world that we have arrived at, that equity prices have been so depressed and treasury prices correspondingly have been so expensive, the yields, current income, are actually more attractive for stocks than they are for the so-called safe asset. There's some other ways that I think can illustrate this opportunity, and one of the things that is probably most exciting, and now sort of switching to more of a global framework here, is this disconnect that has developed over the last few years between the upward trend in earnings per share growth among companies and the PE, or the valuation that investors are willing to pay for those earnings. And over time, as you would expect, there is a pretty close relationship. As earnings migrate up, investors get increasingly confident about the future and typically are willing to pay a higher multiple for stocks. But in the aftermath of the credit crisis and more recently with the European/Greek debt crises, the lack of confidence has been clearly manifested in this tendency for investors to be selling stocks, even though earnings have been, by and large, on an upward trend. So we think that certainly has contributed to the challenges last year, but it also represents one of the opportunities. Here's another way we think about it as well, and I think this is pretty stark. When we measure the difference between how expensive stocks are, the higher this line, which we just are referencing the price-to-book spread for the cheapest 20% of the market versus the least expensive, the most expensive and the least expensive quintiles of the market. Typically when that line reaches such high levels, it's almost always associated with crises as investors become increasingly reluctant or lack confidence in future earnings growth, and as a result, stock prices, particularly for the cheaper stocks, only get cheaper. And what's interesting is you'll notice in that big circle, that represented, at least in this cycle, the highest price-to-book spread, and that occurred when Lehman Brothers failed back in the fourth quarter of 2008. And yet, after making notable progress in the years ensuing, more recently, particularly in the third quarter of last year, we'll notice that that same line reached an even higher peak number than it did during the original Lehman crisis. We think that's pretty extraordinary, and it was probably testimony to how unnerved investors were, particularly around the European situation and what was likely to happen there. We think that it is that psychology that has had more influence on stock prices than the underlying fundamentals. In fact, I would go so far as to say that the fundamentals have been quite supportive and should be supportive of stock prices. And we've seen that even throughout a difficult year last year, that when investors focus less on the headlines and more on the fundamentals, then given the almost violent price reaction in the market, it's clear that there was a lot of laid up or latent performance potential in equities that has been suppressed while investors were concerned throughout most of last year. So we think the fundamentals are there. We think we've started to see some evidence of it being released in terms of stock prices. But we don't want to be naive. There are certainly issues out there that are impacting investor confidence and that we are keeping a close eye on. Probably at the top of the list is the situation in Europe. This one is going to be a difficult one to solve. The most immediate challenge, as everyone is probably aware, has to do with the situation with Greece. They've got an enormous debt payment that is coming up early in March with no feasible way to repay that unless they get another tranche of money from various institutions, the IMF, the European Union, the European Central Bank, and so on. All of the focus here recently has been on negotiations between these authorities, between these suppliers of capital and Greece, trying to come up with some way to restructure the debt in Greece that would give them at least a fighting chance for austerity measures and other cost cuts to hopefully have some beneficial impact down the road. But although there have been some encouraging signs here lately, including today, that those negotiations have been fruitful, there's still a lot of moving pieces and a lot could certainly go wrong. At the end of the day, we think that given the unknown severity or the unknown consequences were they not to arrive at some deal, that it is very likely that Greece and its creditors will reach some sort of accommodation to sort of take that immediate risk off the table. The fear of what happens if they don't should be sufficient enough to focus the mind to actually reach a deal. The longer term issue is going to be much more difficult, and that's what's illustrated on this page, and that's frankly the structure of the union itself. It's very difficult, as they are learning, to squeeze together countries of such widely disparate levels of debt, of productivity, of economic growth, and so on, and expect that to be viable in the absence of clear and enforceable mechanisms to enforce budget discipline, have consistency across tax and spending policies, etc. It's still an open question as to how they will deal with that. Will they deal with it by changing the structure or the membership and hiving off countries like Greece or like Portugal, which they probably should have done at the outset, or will they keep the membership intact and yield to very, very stern, sort of centralized government, if you will, led largely by the Germans? That's frankly an open question and certainly not likely to be solved anytime soon. But that is really the critical issue going forward. It's clear from most market measures that this issue is still out there. The most immediate risk of European banks taking a severe hit on their debt holdings or not being able to fund themselves in the marketplace, a lot of that risk was reduced rather substantially last year in terms of providing additional funding to those banks. But these high levels of bond yields that countries like Italy were having to pay at the end of the year have come down markedly. It tells us that the marketplace is starting to get a little bit more comfortable with the situation over there. And the reason for that is because mainly the European Central Bank, in similar fashion to our own central bank during the credit crisis, has greatly expanded its balance sheet to help finance and float a lot of these issues that, frankly, the private market was not willing to do. So it is certainly unresolved at this point. The immediate indicators are encouraging, but there is certainly a lot of work to do. Switching to the U.S. front, and only in the interest of time will I be brief in these comments, but probably one of the key issues that investors have focused on as evidence that the economy has yet to really gain enough altitude have been indicators around unemployment. And we're certainly all familiar, I'm sure, with recent unemployment and jobs figures. The good news is that even when you sort of parse through headline numbers, there are enough encouraging signs to lead us to believe that we have probably turned the corner on the unemployment front. We're not going to make dramatic progress here, more than likely, until we see some sustainable progress on housing, but it's sort of a chicken and egg phenomenon. Both of those issues, housing and unemployment, are somewhat joined at the hip and have influence on each other, but we think progress in one area will certainly help in the other area, and we're encouraged by indications that the unemployment situation is finally starting to sort of turn for the positive. When we roll this up to a forecast, you can certainly read the page as well as I can, but largely we're looking at a notable slowdown, but not a severe slowdown in Europe and the UK, but a period of recovery out of a recession for Japan, and we should see marked improvement here in the U.S. The emerging markets will still be the fastest growing part of the world, but even there they will be slowing down enough that we think there's actually a positive to that. It removes a lot of the latent inflation pressure that was a concern about a year ago this time, and it also puts many of those countries in a position to start to be more accommodative from a monetary standpoint. But the impact, when you total it up globally, is that the global economy will continue to push along somewhere in the high twos. If we can avoid a repeat spike in oil prices and no unexpected earthquakes or tsunamis that have ripple effects across the global supply chain, perhaps we could even hit numbers higher than that. But by and large, it should be economic progress. Let me quickly pivot to bonds, and then I'll conclude my remarks. We talked about the opportunity in equities. Let me quickly note that as far as bond holdings, whether we're talking about tax-free municipals or regular taxable bonds, that as difficult as the market was for stocks in 2011, it certainly rebounded to the benefit of bonds, sort of continuing the string of strong performance that we've seen in the bond market, really going all the way back to 2008, and certainly bond investors have been cheered by that. The best return, at least outside of the safe haven demand for treasuries, was clearly in the municipal bond market itself, which is quite extraordinary, really, considering a lot of the bad press and the sky is falling comments from pundits on TV talking about difficulties in the municipal bond market at the tail end of 2010. The municipal market actually has weathered through in much better shape than a lot of these Cassandras were saying. And the reason being, we think, it's pretty clear to see it, and that is that the vast majority of issuers, particularly at the state level, are by and large acting responsibly, and that is that they're taking the steps that at the end of the day, whether it involves raising taxes, laying off people, cutting costs, or even dipping into rainy day funds or borrowing, at the end of the day are taking the steps necessary to make sure that they can repay their commitments to bondholders, that those bonds will remain money good. And we think that that will continue, aided by a slow, modest, even recovery in the economy, that will provide even additional running room for these issuers. They're by no means out of the woods, but the conditions are certainly better, and as time goes on, so long as they maintain their discipline and the economy continues to slowly improve, we think that this market still continues to look attractive. The one cloud on that horizon has to do really with what we can expect in terms of returns going forward, because there's an inescapable reality here, and that's just the general level of interest rates illustrated by this yield page for the 10-year Treasury. Having gone through a remarkable multi-decade-long cycle from its highs in the early 80s to where it sits today, the inescapable reality is there's just not much further room for interest rates to fall. It could certainly move sideways for a while, but under any realistic economic recovery scenario, interest rates have to start migrating back up, and that will make future returns in bonds not nearly as good as they have been recently. So while the last 10 years certainly benefited from this continuing decline in interest rates and the troubles in equities, we really don't expect that to be the case in the next 10 years. Please don't read that as an indictment of bonds. We think bonds continue to play a very important role in portfolios. They're still by far probably the best hedge to equity volatility in our world because they exhibit such low correlations to equities. It makes them a very important component of properly diversified portfolios. So let me try and tie this together and state what do we think it's going to take to continue the progress we've seen here in the first 6 weeks of 2012 and hopefully turn this into a continued recovery in the markets, in particular in the equity markets. Well, we think it really comes down to not necessarily coming up with definitive solutions and solving the major problems that still sort of hang over the marketplace, but it does involve more clarity around what the future will look like on these issues, whether it's what does the path look like for Europe over the next few years, what are the risks of a disorderly default by Greece, what are our own tax and spending policies likely to be here in the U.S.? Obviously, an election coming up later this year should provide some clarity around that. What does the future hold for the emerging markets that have gone from being usually the source of global instability as recently as 15, 20 years ago to now really being an engine, a driver of economic growth? Do we need to be concerned about slowdowns in the emerging markets? More certainty around these issues and other attendant issues is really what the market needs, particularly the stock market. Because when that happens, we think that investors, by and large, will be more inclined to focus on the fundamentals of companies themselves, the fact that equity valuations have reached pretty provocative levels, and starting to take note of what are, by historical standards, quite healthy corporate balance sheets and earnings growth, and frankly reach a level of frustration with how low returns are in the so-called safe returns that have been so popular of late. And when that happens, in other words, more of a return to normal, whatever normal looks like, it's almost certainly going to rebound to the benefit of equities and equity investors. So, sort of putting the final point on this, we think that could lead to this year hopefully being a rebound year, and dare I say, perhaps even the return of some optimism. So with that, thank you very much for your time and attention, and I will turn the podium back over to Leanne.
Thank you, Greg. We appreciate your insight and perspective. Just a reminder, before John provides M&A insights, that you can submit questions to us by typing them in the chat box on the lower right corner of your screen. Now I'll turn it over to John.
Thanks, Leanne. Good afternoon, everyone. Certainly a pleasure for me to be here today with the Bernstein team, and I really do see this as, call it the perfect pairing, like matching a fine wine with Bernstein with Colden Company on the M&A side, because many of the comments that Greg had today are certainly things that have affected and will continue to affect the M&A environment going forward. As we can see on your screen right now, when we look over at, if you look at this slide, the best way to describe it, the factors on the far left side, these are the items that everybody looks at and says have an impact on the M&A market, be it domestically or globally. And as you can see from the left side, a lot of the things that Greg did cover, things like the economic environment, investor confidence, the credit market strength, and stock market performance. And as we look at what has happened historically, we all know the recession that occurred between 2000 and 2002, and what did happen, and with 9/11 in particular in this country, and the impact it had on the M&A environment. 2002 and 2007, as we'll see in some subsequent slides, were what I would call the real go-go years of M&A, and are something that a lot of sellers or hopeful sellers are looking to repeat. And while we are in a period of recovery, we're not quite to the go-go years. But as you look at the 2010-2012 column, for the most part, there is optimism as we go into 2012. But certainly, I think as Greg would attest to, there's always the reason for skepticism because there's a lot of factors that we cannot control. So with that, one item that has always been of interest to me is exactly how does the M&A market track to the Dow Jones? And so recently we just put together this slide, the red line being the Dow Jones and its performance since 2001, and the number of deals, the total M&A deals, being represented by the blue lines. And the correlation to me is amazing on how the stock market performance and total M&A deals just kind of go hand in hand. And if 2012, one could speculate if 2012 stock performance continues on its path, we could have a very good year in 2012 on the M&A side. Kind of looking back, this slide shows the M&A activity in North America for transactions under $1 billion. This is what's defined for the most part as the middle market. I will, as I comment, also make some references to what we call the lower middle market. And it's probably those companies, I would say, with sales under $50 million. But as we can see, 2011, I would really describe a year of two distinct halves. 2011 started off fast, started off furious. People were excited and optimistic about what was going to happen on the M&A front. In the first 6 months, we were at record paces for volume of the number of deals as well as dollar volume of deals. About sometime in late June, early July, things started to slow down dramatically. But what was happening? We were starting to experience some economic issues over in Europe. Washington was having difficulty with their budget process. S&P was downgrading U.S. debt. And a lot of different factors started to creep in that made the second half of the year for M&A very slow. And really, we ended, I wouldn't say with a thud, but we certainly ended, at a lower point than everyone did anticipate at the beginning of the year. Some of the factors that we can look at for 2011, the number of transactions that were completed by private equity firms were at the second lowest level as a percent since the year 2001. Private equity represented roughly 25% of the total dollar volume in 2011. What are some of the other takeaways? Valuations continued, and we have a slide on this, continued to go up in 2011. So the price to EBITDA that we'll see did continue to rise. Synergistic buyers were out in force during 2011 as they look to find growth that is not coming in, from their own businesses, but really from acquired businesses. The bias on lending, while credit markets continue to improve, there is a bias to larger deals. Larger deals right now we're being levered at over one turn more than deals under $50 million. And conditions are actually worse in the lower middle market. Bankers continue to be conservative, continue to look at balance sheet strength in hopes of making the right deal. And again, not all bankers' fault. It's what the regulators are demanding at this point in time. We did see a bias creep in for pricing to better companies and better performing companies. And again, they are getting oftentimes, 1 to 2 times more than their counterparts that do not have the same type of growth in earnings. So overall, again, 2011 in North America, kind of a mixed bag. A half year great and growing. The second half slowed down with some of the caution that occurred from the forces outside that are going on in the economy. On a global basis, as we see on this slide, best that can be said, Europe, except for Germany, which actually had an increase in transactions of over 30% for the year, and the UK, surprisingly, which had a modest increase from 2011 over 2010. There was little, if any, activity going on in Europe because of all the economic uncertainty and really the recession that a number of the countries are in. Asia, excluding Japan, was actually up close to 10% year over year, and China alone was up over 6.5%. And that was in spite of China, actually, as many of you will recall, China's economy did not grow at the pace that was anticipated at the beginning of 2011. But China, again, is becoming a major player on the M&A side. In terms of industries, both domestically as well as globally, that continue to be the hot industries in 2011. We're looking at technology, healthcare, financial services. One that I think people in Wisconsin, could identify with mining. Besides Erie, we can think of. Mining is starting to become a very hot industry for transactions. Valuations in certain industries, healthcare and technology are two areas where we see good valuations as well. As we look at valuations a little bit more closely, you'll see that 2011 we continued to get an uptick in the prices paid for businesses. And the other thing that I would point out on this, if you think about what has happened in 2010 and 2011, companies' earnings have continued to rise. And so if you look at this slide very closely and you see that the multiples are expanding, that is on an ever-increasing earnings base. So it's really been a very nice and significant recovery from 2009, and I think we are getting to a point where if we ignore the 2007 very hot days with unprecedented leverage, I think we are getting to a point of having some very fair and very attractive valuations in the marketplace. Why is some of this happening? Well, of course, we know that equity we know that the credit markets, especially for larger deals, credit is available, credit is very cheap at this point in time, and in fact, the average equity contribution to transactions did decrease to only 38% in 2011. The low point over all the years shown was in 2007, when the equity contribution was roughly 31%. But as recently as 2008, 2009, 2010, those equity contributions were above 40 and sometimes closing in on 50%. So certainly the ability to increase the leverage on transactions and being cheap, pretty cheap money overall, did contribute to the increase in valuations. Again, the bias is for better performers, and we see this even holding true in the lower middle market. So let's hear, what do I think about as we go into 2012? I would certainly say there is a number of reasons for optimism. One that's, when you look on the money on the sidelines, right now, and it's reported that, synergistic buyers have over $2 trillion of cash on their balance sheets. It's money that's earning near zero in a very slow growth economic environment. So the synergistic buyers need to do something to generate returns not only on that idle cash, but also just generate returns for their shareholders and look for growth. And a lot of experts are saying that M&A might be the cheapest and quickest way to grow the top and bottom line in businesses. Private equity continued to raise money. Last year raised over $95 billion, and private equity has over $400 billion of funds that need to be deployed. Many of these funds have been raised, if you think about it, prior to the 2010 and as late as 2007. And these funds, the investors are looking, the limited partners are looking for this money to be deployed. So I think we will see private equity wanting to play a role in it. Other positive drivers, private equity exits. Their portfolios are aging, and there's going to be a number of exits that will have to be made by private equity firms. Banks are lending, true statement, and we think that this trend will continue, and we are hopeful that the trend gains some momentum for the smaller deals. Again, the bias, banks love larger deals. We understand that because it's a sophistication of both buyer and sellers that assist the banks in making their credit decisions. But certainly, as credit markets continue to open up for the smaller deals, I think we can see a lot more activity happening overall. What are headwinds? Certainly, similar to last year, we still have Europe that needs to be resolved. I read something this morning that said Greece reached a deal, and then went on to say sort of. And I think that's been, what's been happening over in Europe for the last 6 months. We think something is fixed, but not really. We are in 2012 in the United States in an election year. What is that going to do? Is that going to be a positive or negative? I don't think anyone knows at this point in time, but certainly it does present a level of uncertainty. I think similar to last year, those of us like Leanne and I who are in the M&A world, we're optimistic. We believe it can be a very good and positive year. We think valuations will continue to hold up, if not get better this year. In particular, if there remains a shortage of good sellers, and hopefully we can continue the trend throughout the course of the entire year. So with that, I will turn it back to Leanne.
John, thank you very much. Now it's time for some of the Q&A, and we have had some questions come in. I'm going to pose the first one to Bill Evans. Bill, as you rank risks that could derail economic recovery in 2012, what are your top three?
Great. Well, thank you, and thank you to both the three prior speakers. Great job today, first off. But I think we certainly in both cases, from the investment perspective as well as the investment banking perspective, I think have come to an agreement that clearly we're off the lows, both from an economic recovery standpoint and a market standpoint from 08-09. But obviously there's many risks that can derail the nice momentum that we have. And I think both Greg and John highlighted the obvious 800-pound gorilla in the room is Greece in the forefront, but just in general contagion from a recession in Europe as a result of the overall sovereign debt crisis. So we've spent some time on that. Let's move on. I think the other two biggest ones that have been lightly touched on are, when I think of the U.S., I think most people think of the U.S. as an importer and a major consumer. We're both of those things, but we're also one of the top three exporters in the world. And what we've seen in the latest recovery is a shift in our exports away from our traditional partners into the emerging markets sector. And it's really been a leader in terms of our economy being able to recover. So any kind of faltering in the emerging markets sector and or coupled with two of our top five trade partners from an export standpoint are China and Japan. We all know Japan's been mired in a 20-year plus malaise, so low interest rates, weak economy, and China's been going gangbusters but shows signs of cracks in their armor. So, really any type of a slowdown from that combination of export markets poses a threat to the U.S. And then lastly, we have our own problems in the U.S., clearly. We still have stubborn high unemployment, weakness in the housing market, but probably most importantly and most scary would be, the massive budget deficits coupled with, unsustainably high debt levels, entitlement programs. So when all that comes to roost is extremely hard to predict or determine, but I guess I'm ending there, but I would start that that's certainly something that keeps our portfolio managers up at night as well.
Okay. A second question, John. Are the hot industries the same for both the M&A market and the capital market?
Thanks, Leanne. And if Greg's still on, we can maybe compare notes, Greg. But again, on the M&A side, the hot industries, and this has been consistent for, I would say the last 3 years have been, technology certainly has been number one. And I believe as, we look at valuations of certain technology firms, be it an Apple or others, that, the hot industries on the capital markets are certainly a hot industry on the M&A side. And if I think Google and others, or Facebook and their announced IPO, I think that we are, those kind of go hand in hand. And similar to the chart we showed on M&A and Dow Jones, I think there is a correlation. Healthcare is another one that is certainly, seems to be a hot industry, capital markets valuations, as well as, a number of M&A deals and valuation in particular on M&A deals. So I think it's pretty much hand in hand, and which, does have a lot of logic to it because, value is based upon, at times the deal's done and how people perceive, the potential of takeover.
Greg, do you have any comments to add to that?
Yeah, I'd be happy to. I think from a sector valuation standpoint, the sectors that did the best last year were certainly more defensive in nature. Think of telecom, think of consumer staples, think of utilities. Everything else that we would sort of broadly lump into the cyclical category earnings by and large were favorable, but PE multiples declined, and therefore stock prices eroded. So starting 2012, really the most valuation opportunities, at least at the sector level, are in those sectors like materials, like energy, like IT, to a certain extent in healthcare, that didn't get the benefit, as much benefit as the more defensive sectors. So the telecoms, the staples, the utilities would not be nearly as attractive from a valuation standpoint. The one puzzle is probably still in the financials. Financials are certainly cheap, but the path forward for a number of those industries within financials are still so opaque that it probably doesn't warrant an overweight at this time.
Okay. Another question that has come in for you, Greg. Someone would like to hear your comments about U.S. deficit issues and the unsolved housing crisis.
Okay, so let's talk about housing first. Clearly, the housing situation has not shown clear evidence of a definitive turn, but we think the pace of deterioration has slowed. Just for instance, some of the recent housing data that came out in January tended toward the improving side. We saw existing home inventories showing the biggest improvement in a long time. The existing home inventories were down 21% on a year-over-year basis and are back very close to the pre-bubble range. Although we do still expect some increased volume of foreclosure homes to work through the existing home channel this year, but as some of the early indicators, sort of your leading indicators in the housing space, for instance, monthly home builder surveys have started to show a very noticeable improvement. And those tended to be, they can certainly be early, but the scale of the improvement in those surveys lends some credibility. We think that if we can continue to see improvement on the employment front, there will be enough of a spillover effect that we could be setting up 2013, not 2012, but 2013 for a pretty noticeable improvement off of 2012. So if things continued on the path that they are, we would characterize this year as a year of stabilization, and perhaps next year could set up for some improvement. On the debt and the deficit situation, clearly this is an issue that is unresolved. It is not for lack of understanding of the scale of the problem, and it's not for a lack of potential solutions. What is lacking is political will. The super committee, so-called, was an abject failure last year, and both parties in Washington share some level of responsibility. The process, it's a political process that has failed at this point, and I suppose the only good news on that front is that we do have elections, and we do have an election coming up later this year where this is likely to be certainly a very important topic for the voters. And so right, wrong, or indifferent, as I said in my comment, something that will provide some clarity as to the path forward after the election will probably be beneficial. But just judging from the nature of the question, let me be very clear. Although at Bernstein we're feeling optimistic about this year, and we believe that equities, as an example, represent a very attractive opportunity, the long-term debt situation in the U.S. is an issue that has to be tackled. It has to be tackled. There would be no forgiveness for anyone in power in this country were they to fail to miss the signals coming out of Europe of what can happen in the future if we don't get control of this. And so the good news is that the situation, barring some catastrophic outcome, is not likely to derail the recovery here in the short term, but it certainly will have an impact on the long-term productivity and standard of living in the country.
Thank you, Greg. I'm going to toss the final question to John. John, what are your thoughts on senior debt market in 2012? Kind of thoughts around borrowing multiples, covenant requirements, etc.
Thanks, Leanne. I think that we will continue to have a good and robust senior credit market. Part of the driver that continues to exist is that banks do have a lot of dry powder. They need to lend money to make money for their shareholders, and are certainly out there, looking to finance transactions. Companies that have access to public debt markets, it is still a good public debt market. They can go raise money at fairly low rates, and so they are anxious to do that. In terms of leverage on deals, the senior debt leverage in 2011 was starting to approach the highs that we saw back in 2006 and 2007. We are probably a half turn at most below what the senior debt levels were back in those years. So I think we might be getting near the edge of the total leverage on transactions. A little more room to go, but I'm not sure. Hopefully not too much further, because certainly there's probably a number of people on the call today that would say that things got a little bit too frothy back in 06 and 07 and led to some of the crisis in 08 and 09. I think where we still might have a little bit of room is on the covenant side. Anecdotally, Leanne and I hear in the marketplace that we are back to, I wouldn't say covenant light, but certainly we have heard where on some smaller deals, which would normally